Welcome to the deep dive,
Yeah.
where we try to, cut through all the market noise and just deliver the insights that actually matter.
And today's is a big one.
It really is. We are wrestling with a story that, it perfectly encapsulates the current chaos in crypto-adjacent finance.
The dramatic collapse of Bitmine Immersion Technologies, BMNR.
BMNR, yeah. We're talking about a stock that it plummeted a stunning 24.4% this week.
And this isn't just a bad day at the office. This is, well, it's a catastrophic reaction that reveals a pretty fundamental flaw in a whole category of investments.
It does. And for you listening, this deep dive is really a shortcut to understanding that flaw. So our mission today is twofold, really.
First, trace the mechanics of why BMNR crashed so hard.
And second, and maybe more importantly, scrutinize the whole business model behind these so-called crypto treasury stocks.
Right.
And let's not wait. Let's just get right to the core paradox, because this is the piece of information that should immediately, grab your attention. After that massive slide, BMNR is now trading at a price below the actual market value of the digital assets it holds on its own balance sheet.
Just think about that for a second. The company is, and I mean literally, worth less on the market than the crypto and cash it has.
It's the equivalent of buying $1 for 80 cents.
Exactly. Except in this case, the market is screaming that the structure around that dollar is so toxic they won't even pay full price for the underlying asset itself.
It's just such an extreme indicator of negative sentiment. The market has reached its verdict.
No question.
So our sources for this really focus in on BMNR's recent history, and by extension, the broader investment case for companies that are just holding assets like Ethereum.
And to really get the vulnerability, you have to start with how BMNR even became this thing.
Okay, so let's define the vehicle first. What are we talking about when we say crypto treasury stock?
For anyone who's not familiar, it's basically a publicly traded company, a wrapper, if you will, whose main purpose is just to hold a large amount of a specific digital asset.
The idea being it gives traditional investors exposure to crypto without, the hassle of setting up a digital wallet or dealing with custody.
That's the value proposition in theory.
Right. But BMNR's path to becoming this vehicle was anything but simple. After a recent change in management, the company just pivoted entirely.
They did. They stopped trying to be an operational business and just decided, hey, our best future is as a pure investment vehicle.
Focused solely on holding crypto.
And that kind of radical shift requires massive capital. To fuel this new strategy, the company went on an aggressive capital raising spree.
How much are we talking about?
Over $7 billion.
$7 billion. That is a staggering number. How did they pull that off?
The simplest but also the most impactful way, by issuing a massive number of new shares of their common stock.
And that's a crucial point, because it hits existing shareholders immediately.
It does. You see, before they even bought a single Ethereum token, the very act of raising that $7 billion instantly diluted the ownership stake of every single person who was already on the books.
So the corporate structure itself introduces a drag on value right from the very beginning.
Precisely. The money came in, but everyone's slice of the pie got smaller, just to fund the strategy.
So what did they buy with all that cash?
Their core holding, as of their latest update, is 3.56 million Ethereum tokens.
So they've essentially tethered the entire fate of their public stock to the volatility of Ethereum.
For better or for worse, yes.
Okay, so let's connect the dots. The company's market cap is now around $10 billion.
Right.
But the value of those Ethereum tokens, their main asset, was sitting at $11.8 billion just a few days ago. That's a clear anomaly.
A huge one.
Why the discount? Why would investors only pay $10 billion for something worth almost 12?
It's the market screaming a message. When you see a deep discount to net asset value, or NAV, like this, it's usually one of two things.
What?
Either investors don't trust the valuation of the assets themselves, or they don't trust the management or the structure holding those assets.
And since Ethereum is a liquid crypto asset with a clear market price,
the verdict is clearly on the corporate structure. The market is saying the wrapper itself has a negative value.
A negative value of almost $2 billion. That's a terrifying picture of distrust.
It is. But to understand that rapid 24% collapse this week, we actually have to look outside BMNR itself.
We need to follow the correlation chain.
Exactly. When a company basically turns itself into a publicly traded fund for one asset, you get what I'd call the great correlation.
Meaning BMNR stock and the price of Ethereum are just inextricably linked.
Right. And if ETH falls, BMNR stock will probably fall even further because of that corporate discount we just talked about.
And Ethereum has definitely been taking a beating lately. I mean, it's the second biggest crypto, and it's had a really rough month, down, what, 28%?
Nearly 28%, yeah. The sources point to a kind of perfect storm of technical market pressure and broader economic weakness.
Let's start with the technical pain. You mentioned something called liquidation.
Right, so liquidation, it sounds scary, and it is. Think of it like a forced sale.
A forced sale.
Yeah. A lot of traders in crypto use leverage. They borrow money from a trading platform to increase their position size, hoping to amplify their gains.
They're trading on margin.
Exactly. But when the price of the asset Ethereum, in this case, drops below a certain point, the platform automatically sells the trader's holdings to cover the loan. That's a margin call, and the sale is a liquidation.
So this isn't people deciding to sell. It's automated, forced selling, hitting the market all at once.
All at once. And when large leveraged traders get liquidated, it creates a cascade. The forced selling drives the price down even more, which triggers more margin calls and more liquidations.
A vicious downward spiral.
It's a mechanical domino effect. And BMNR's value, tied directly to ETH, got caught right in the middle of it.
And we also have to remember, cryptocurrencies don't exist in a vacuum anymore, do they?
Not at all. We've seen for a couple of years now that they're pretty correlated to the traditional stock market, especially to growth and tech stocks.
Which have also had a difficult week.
A very difficult week. So BMNR got squeezed from both sides. Specific technical pain from the crypto liquidations, plus the general drag from the broader tech market weakness.
Okay, so we've established a cause of the collapse. It's a mechanical fall driven by Ethereum's weakness.
Right.
But this is where we have to pivot. We have to ask the critical investment question that this whole situation raises.
The big one.
If the entire purpose of Bitmine Immersion Technologies is to hold 3.56 million Ethereum tokens,
Yeah.
then why, logically, would any investor buy BMNR stock instead of just buying the Ethereum directly?
And that is the fundamental intellectual hurdle that this model it cannot overcome, not in today's investment world.
Go on.
These crypto treasury stocks like BMNR or Strategy, formerly MicroStrategy, they were maybe interesting concepts a few years ago when getting access to crypto was hard.
For institutions, you mean?
For institutions, for certain regulated funds, yeah. But today the sources are unanimous on this. They just don't make logical sense for investors who can get direct access through exchanges or wallets or even regulated ETFs now.
I get the historical appeal. You buy a stock in your normal brokerage account, you get crypto exposure. Simple.
Seems simple.
But now that retail access is trivial and institutional access is getting better every day, what exactly are you paying for when you choose BMNR over ETH?
You're paying for a layer of completely unnecessary corporate bureaucracy, complexity, and risk. When you buy Ethereum through BMNR, you're not simplifying things. You're actually layering on 3 distinct categories of risk that actively eat away at your potential return.
Okay, let's break down those 3 risks, because understanding them is the core lesson here. It explains that massive NAV discount we started with.
For sure. The first one is the most immediate: overhead costs. When you buy Ethereum directly, your main cost is, a small transaction fee. When you buy Ethereum through BMNR, you are taking on the costs of running an entire publicly traded company.
Now, what does that entail?
Executive salaries, which can be huge. Rent for offices, compliance costs, legal fees, auditors, investor relations, the whole G&A line item.
And all those overhead costs are constantly eating into the value of the assets.
Constantly. Even if Ethereum's price stays completely flat, BMNR has to sell some of that ETH just to pay its bills and keep the lights on.
That's a corporate drag that a direct ETH holder never, ever faces. It's a permanent haircut on your potential profit.
That's a great way to put it. Then the second major risk is dilution risk.
We already saw that in action with the $7 billion raise.
We did. That risk was realized. But the risk continues. Management could absolutely do it again.
So they could just decide to issue more shares whenever they want?
If they decide they need more capital for whatever reason, maybe to buy more crypto, maybe just to cover a budget shortfall, they can issue new shares. And every single time they do that, your ownership percentage gets smaller, you get diluted further, and you don't see a penny of that new capital.
And since it's the management team making all these decisions, that brings us to the third risk, which seems like the most abstract, but also maybe the most damaging.
Management risk. It's the ultimate human factor.
Meaning you're exposed to the chance that the management team will just make a bad call with your money.
Precisely. When you hold ETH directly, you face market volatility. When you hold BMNR, you face market volatility plus the risk of corporate error.
Can you give us an example of how that might play out?
Well, what if management decides to actively trade some of the treasury? They could misjudge the market, lock in huge losses. Or what if they try to get creative and put some money into a much riskier, less liquid altcoin that then crashes to zero?
All strategic choices that a direct ETH holder is completely exempt from.
Exactly. You're also adding corporate governance risks, things like scandals, misreporting, or just plain old bad capital allocation.
So to sum it up, you have a centralized corporation built to wrap around a decentralized asset. And that wrapper introduces drag from overhead costs. It reduces your ownership through dilution, and it adds complexity through management risk.
And the market, as we've said, seems to be fully aware of this. That massive discount to NAV is the proof.
It's the evidence. When the market is saying, we value your management and your corporate structure at negative $1.8 billion, that is not a gentle critique.
No, it's a complete and total rejection of the entire value proposition.
So what does this all mean for you, the investor, watching this dramatic fall? Let's just recap the key findings.
The key takeaway is structural. BMNR's business model makes it a pure proxy for Ethereum. Its steep fall this week was a direct mechanical result of the crypto market downturn, which was made worse by all that leveraged trader liquidation.
And the ultimate sign of the market's severe disappointment is that core paradox we keep coming back to. The stock trading below the value of its own assets. It just shows a profound lack of trust.
It does. The market is fundamentally unwilling to pay for the centralized complexity that's been built around a decentralized asset.
Which raises a really important and I think provocative final thought for the future of finance.
The systemic risk this model represents isn't just about if crypto falls. It's about why an investor would voluntarily choose to layer all this corporate complexity, all those costs and all that risk onto an asset that was specifically designed to be efficient and free of intermediaries.
It's the ultimate paradox, isn't it? You take an asset built on trustless technology and you wrap it in a layer of centralized corporate trust.
A layer of trust that the market is now actively saying it doesn't believe in. It really makes you wonder about the long-term viability of these kinds of financial intermediaries in a truly decentralized world. If the market aggressively discounts a company's assets by nearly 20% simply because that company is the one holding them, what does that tell you about the future value of traditional financial intermediation in the age of crypto? That's the question BMR's collapse leaves us all to think about.